following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host for the show, David Blain. We thank you for joining us today on 94.1 FM WNBU as well as cable TV 10 in New Bern. Also, all those of you listening or watching our stream off our website, www.dlblain.com. There we have all the archives of the show posted a couple years now. Hard to believe we've been on the air for several years now, but if you want to go back and listen to some of the words of wisdom that we've had over the years, or if you just miss a segment, we've broken it up into 7 and 8 minute segments so you can watch as much or as little as you like. Also, you can contact us at allthingsmoney@dlblain.com if you have any comments or questions on the show, topics you'd like to see us addressed. And our phone number is 252-633-0107. We love to hear from our viewers and listeners out there. Let us know what's on your mind. So today we've got a lot on our plate to cover. Wanted to start off with a quick update. As you know, the market had a severe decline back in August and has been sort of muddling through the past couple of months. The past week, we've had a nice rebound, and so I thought it might be useful here in the first segment or two to just kind of talk about what is happening and what we see for the future. If you recall back, we've been discussing the fact that during this year is probably going to be a decline, and sure enough, it has happened. If we look at what's going on in the world, in the U.S., there's not very many stocks that are in positive uptrends. We see that only about 15% of stocks are above their 40-week moving average. 40 weeks, that's roughly 10 months. It's kind of a key indicator. Some people call it a 200-day, 10-month, 40-week, different ways to look at the same statistic. But it's essentially a measure of how many companies' price trend is moving in an upward direction. As a general rule, if everything is moving in the opposite direction, unless you're very good at finding the bottom, you can predict that this is a bear market that is investing. And in fact, we saw that last week on Monday, the market briefly touched into bear market territory. So we look at the trend. One way to gauge that is what percentage of companies are going up. That's pretty obvious. And so we see that during times of when the numbers get down this low, we use the phrase, it's almost so bad that it's good. Because what happens is that the majority of companies are not going to stay down forever. That as a market as a whole, the bias is swings from upward to downward, and whenever you reach your extreme, you would expect whatever that situation is to reverse and go in the opposite direction. Whether it be multi-year periods of time where you have extraordinary gains in the stock market or bond market, you would expect that at some point that is going to reverse. That, and if we jump back to the year 2000, I think that was the problem that a lot of people had, was they assumed that this trend would continue forever. And mean reversion is a very powerful thing. And so right now, we have very few stocks heading upward. And so we would fully expect a nice rally at some point. Now, how long it goes on, we've been had an upswing for a week now. One of my favorite indicators is the sentiment. The sentiment of the market takes into account the psychology of the market. And as we look at that data, we see that our main sentiment poll that we use, the Ned Davis crowd sentiment poll, is at 38.4. And to give you a perspective, anytime that the sentiment drops below 57, we generally see positive returns. At the low in 2009, we saw sentiment get all the way down to 30.9. last summer where we had a similar decline to now. We saw sentiment get down to 40.5. Going back to the 2002 lows, we see it got down to 33, and the 98 lows were 33. So from a sentiment perspective, we're definitely well on our way to seeing the bottom, at least in the short term. On a secular basis, I'm not sure if markets have gotten cheap enough to start a new secular bull market, but certainly from a cyclical perspective, this appears to be somewhat of a bottoming process. When we look at, one of the other things we look at is what's called the Copic guide, which is another indicator we look at for the Dow. It's still not very positive. When we look at secular periods in the Dow or the S&P, we'll just talk about the Dow for a minute, have averaged 15, 16 years at a time. And what we mean by secular period is multi-year periods of above average or below average returns. This is cyclical. If you go back in history, kind of getting away from the markets, economic cycles are cyclical. Countries, empires, the world and nature itself is cyclical. You have birth, growth, decline, decay, and death. And markets are no different. These are some immutable laws of nature. And so we see that these patterns exist both within nature, economies, and the financial markets. Now, it's very difficult to pinpoint exactly. They're not, exact patterns that you can define, this number of years, that number of years, but it's kind of a general period of time. You have to understand the general time frame that you're investing in, and currently we're in what's called a secular bear. Now, typically, in order to get to the start of a bull market, you need PE ratios, price to earnings ratios, to get down very cheap. Stocks have to be very cheap. If you look at rates of change, you have to have multi-year period of lows. And so we don't necessarily think that we're at that point yet. At least another year or two, I think you'll see some of the similar range of patterns. A market goes straight up and then straight down and then sort of a muddling along. I don't think we've reached to the point where we're ready to launch into, a multi-year upswing in the markets. And by multi-year, I mean, decade-long upswing in the markets, a new secular bull market, such as we had in the period of 1982 to 2000, which incidentally a lot of people are still stuck in. This is a secular bear market that requires a little bit different investment strategy than a secular bull market. Okay, so back to the shorter term, we think that we're in a bottoming process for the cyclical bear, and that the rally that we're currently in will probably continue for at least a few more weeks. We're coming up on our first break, so for All Things Money, I'm David Blain. We'll be right back after a few short messages.